Well, hello there, folks. Welcome back to the channel. So today I wanted to make a brief video to give some of my knowledge and experience as an example of how you can better trade options. So the case in point being Monday, June 13th, I had picked four put option trades that at the end of the day all turned out to be winning trades. But the only thing that happened is they didn't go through. And this is something that everyone should pay attention to because if you followed the market Monday, so the market opened massively down on Monday. And for these trades to have gone through, what I should have done, I should have put them in like Friday before close of market, like at 3:50 p.m. And I've definitely learned from this mistake because by the end of this video, I'm going to show you what these trades would have made. I have those cells bleeped out right now so that you'll follow along and watch all the way to the end, which would be great because this is a very beneficial lesson, I think, to everyone. So I kind of figured the market would open down Monday. So I went ahead and put in limit orders for four put trades. Historically, I have my most options experience with calls, but in this case, since we're really entering into more and more of a bearish market, put options are, in a lot of ways, a better option, right? No pun intended. So I picked four trades for four different companies: JP Morgan, SEMO Semiconductors, Apple, and Qualcomm. And over the past week, the market's really been teeter-tottering. Like there's been days that call options would work for a day. There's been days that put options would generate massive gains, this day being one of them. So what happened? So the limit prices that I put in were basically where the positions closed Friday. But in intraday futures trading, the market was already down like 800 points by open of business that day. So none of these trades actually went through. But just for fun, I followed them all the way through the day. And so had these trades gone through, this would have been the cost. So as some of you know that trade options, this first trade, this is a JP Morgan June 24th expiring put option at $115 strike price. Plus two means two contracts, buy to open. These are all buy to open. SEMO Semiconductors, July 15th, $85 put, two contracts. And remember, one contract allows you to control 100 shares. So two allows you to control 200 shares. It gives you more leverage. That's why in a lot of ways, these are more profitable, way more profitable than stocks, but they can also lose you a lot of money too. The price for the first one was $1.67 per contract. The second one was $1.50. And then Apple expiring June 24th, $135 put, only one contract, buy to open, $3.10. Qualcomm, two puts at $130 strike price, buy to open, for $3.10. So, and this would have been, had all these gone through, this would have cost $1,564. And then they all were, like I say, winning trades. They all were successful that day. So you can see here the price by 1:38 p.m. yesterday, June 13th. You can see these were all up. So $2.85, $2.35, $4.97, and $4.80. So this $1,564 by 1:38 had turned into $2,497. So a $933 gain before the market even closed. 570, 470, 497, and 960. And then 10 minutes before market close, they were even higher. So this, watch this. You see the percentage down there, 84% gain for one day. So these would have closed, if I had been in these and just got out of them within the same day, 650, 520, 593. And then how about this one, $1,116. Net revenue of gross proceeds at the close, $2,879, and then a profit of $1,315 or 84% off of $1,564. So how about that? So some people think hypotheticals and what ifs are a waste of time, but in this case, I would say I got the direction of the market right. All the trades were right. It's just that in the intraday, the market opened so far below what it had closed at Friday evening that none of these went through. And yeah, I was kind of mad about it, but I've learned a valuable lesson to where if I really am confident about the direction of the market, to get in the day before the market closes, which by the way I did. So today I thought that the market would open in a slightly bullish direction, which it did. It didn't last long. So that Qualcomm position here, I actually bought into a call at the June 24th expiration, made $165 gain, a lot less than what I would have made on these put options the day before. But I closed out of this quick because any of you that followed the market saw today, it reversed course rather quickly. And then for tomorrow, if any of you have been following the news, you'll know that the Fed is expected to raise interest rates 75 basis points or 0.75% tomorrow. So that means that the market is likely to be very far down tomorrow. So the only thing I did for tomorrow, because honestly, I got nothing other than this at this point, is an SPY put on the SPY. So expecting it to drop tomorrow. But the takeaway from this is that you may be right on the direction of the market. You could be right on all of your trade ideas, but if they're not in time, timing is a key component, obviously. So if they're not in at this limit price when you can get it, they're not going to get filled and you can miss out on massive gains. So, and that's the thing with the limit order. Now, could I have looked again and tried to adjust higher? Yeah, I could have, but like I said, these were already higher by the time the market opened because, again, put options go higher when the market drops. It's a short position or a bearish position. So again, key takeaway, the timing has to be a little bit better. So hope that lesson on one of my mistakes was valuable. If you like that, please remember to like, comment, and subscribe. And the next video I'm coming out with, which I've wanted to do a while, is going to be my top passive income ideas. I'll break them all down. There's probably going to be anywhere from 8 to 10 of them. Keep an eye out for that maybe tomorrow or Thursday. Thanks so much. Have a great day.